Hi, my name's Abu Cassim. I am founder of Jozi Angels. We are an angel investor network based in Johannesburg. There are 29 angels in our network, and we've made a total of 44 early stage investments. Market nuances are going to determine a lot about the average investment. That includes the sectors that are most profitable, the average ticket size. We at Jozi Angels have invested on average 700,000 Rand for roughly 15 to 20% of equity where valuation is possible. That equates to about $50,000. The biggest investment we've made is 5 million Rand, and that equates to roughly $350,000. But that number is going to differ from market to market and really be driven by the liquidity in each market. Each angel is going to have his or her own preference in terms of what they'd like to invest into. But typically, the angels we've come across look for 6 things in the main. Firstly, the idea, the solution. Is it innovative? Is it unique? Is there any intellectual property that we could potentially export? The second thing is the team, and that's probably the most important thing. Can the team execute on the plans that they've got? And there's an investment saying that we prefer to invest in an A team with a B idea over a B team with an A idea, essentially insinuating that team is more important than idea. The third thing we look for is market opportunity, and it's a question of how big is that market, can the solution scale into that market, and is that market accessible. The fourth thing we look for is fit, and that's essentially, is this a good solution for me as an investor? Does it meet my investment criteria? Can I add non-financial value to this particular solution? And what I mean by that is does my knowledge and my networks lend to this as a solution? The next thing we look for is traction, and that's essentially what's happened to date. And the reason why we look at traction is it does mitigate one of the biggest risks in investing in startups, which is the risk of market adoption. And then the last thing we look for is return on investment. What does the journey look like? Are we going to make money from this particular investment? And when does that exit look possible? As mentioned previously, team is a very important aspect of what we look for in a business. And there are angel investors that will not invest in solopreneurs. A solopreneur is essentially a single person running a business. And the theory goes that there is a spectrum of skills required to make a business successful. And it's very rare to find that entire spectrum in one person. Often you need 2, if not more people to run a successful startup. Specifically, we look for integrity, passion, startup experience, domain expertise, operating skills, leadership ability, commitment to the venture, long-term vision, realism and pragmatism, flexibility, and even temperament and execution track record. Raising startup funding as a founder is again a function of the market. The length of time it's going to take a founder to raise money is dependent on how many investors there are, how much liquidity there is. So it's going to differ from market to market, but typically 6 months in the South African context. I always advise startup founders to begin those relationships long before capital is actually needed. Investor relations is hugely important in the investor game. We don't invest in founders that we don't know. And so the sooner you begin the relationship, the easier then becomes when you are actually looking for capital. I think the first thing you should note is that there's no typical angel. The questions you're going to get from an angel investor are really references to their history. If you are speaking to an accountant, a lot of the questions you're going to get are going to relate to your financials, your projections, your assumptions. If you are, however, speaking to a technical specialist, a lot of the questions are then going to relate to the product and the technical aspects of the solution. So it's going to differ from conversation to conversation. I think it is important to apply your mind when it comes to putting your forecast together, and make sure that the logic stands up, because that logic is almost always tested by investors. Yes, an entrepreneur will get questions on their market. I think one of the first questions they'll get is, what is the market size? Another question is, how do you plan on acquiring your market, your target segment? What is your acquisition strategy? Third question they could get is, how fast is this market growing? I think ultimately what the investor is trying to determine and ascertain here is the entrepreneur's understanding of the market that they are servicing. Yeah, any experienced angel is going to spend quite a lot of time assessing the team. And some of the questions that the team may get in that assessment is, who are the team members? What are their roles? Who are the key members of the team? What are their domain expertise? Are you outsourcing any functions? What is unique about this team in their ability to execute on this business plan? Are there any areas or skills that you are lacking and maybe need and plan on acquiring in the short term? Any experienced angel is going to spend a lot of time understanding the team that they are backing. Angel investing is extremely risky. It's in terms of the spectrum, there's keeping your money under the mattress, there's gambling. Angel investing is probably just to this end of the spectrum. It's important for angel investors to diversify. The statistics are globally that 95% of startups are going to fail, and angels then have a similar return trade-off. 95% of the companies that they are investing to probably not going to succeed. If they choose well, that number goes up slightly. So from 5% it could be 10 or 15%. But there is a saying in the investment world that for every 10 startups you invest into, expect 3 to bomb out completely. That is, you'll get zero money from that. Expect 3 to do okay, you'll get some money back. 3 will do decently well, you'll actually make money from your investment. But hopefully if you choose well, you'll get 1 that goes and shoots the lights out, and that gives you back all the money that you lost in all the others, plus a whole lot more. I think finding an angel is always challenging across the African continent. There aren't many, unfortunately. I think if you are looking, the first place I'd suggest looking is in popular publications. So in the South African market, Venture Burn, Disrupt Africa come to mind. get a sense of who's making investments and if those investments are in and around the sector that you're operating in. The second place I'd look is LinkedIn. Just jump online and try and find an investor, your ideal investor. Sometimes, often, that person's not investing or hasn't invested yet, but could be open to investing over time. And then the third place I'd look is Google. Just do a search for angel investors in your city. And then lastly, I'd look at the African Business Angel Network. There's quite a number of network members across the African continent. The question of an NDA is always a hot topic. I personally and members of my network won't sign an NDA for four main reasons. The first one is it's time consuming to execute. It usually starts with you sending me a template. We have a back and forth in terms of that content. I sometimes share it with my lawyers, and you may share it with your lawyers. Could be weeks, if not months, before we actually execute on that document, time which we've lost in building a business. The second thing is it's often difficult to actually know who's breached that NDA. Often if you are signing NDAs with one person, you're signing it with many people, and then it's a question of doing an audit trail around who's breached that NDA. Then the third reason that I wouldn't sign an NDA is that even once you've confirmed that I, for example, am the one that's breached that NDA, it's then quite expensive to go through that litigation process and time consuming as well. So all three, there's loss of time and money which could have been better spent on the business. And then fourthly, if I sign an NDA for an edtech business, often they disclose information to me that I know already, information that I've acquired in my understanding of that market, and then they may think that it's information that I can't use going forward. So it lessens my impact on a business that I could potentially invest into at a later stage. So we spoke about earlier that angels offer or bring quite a bit to the table: knowledge, networks, and capital, in that order of importance. But if I've signed an NDA, I limit my knowledge and my networks that I can bring to the table. Often the due diligence process is a one-way process, with the angel and sometimes the venture capitalist asking all the questions. But I think as a founder, you need to understand who's going to be investing in your business. These are essentially partners that you bring into your business. And the analogy is made to marriage, where any investment is like marriage. And I've often heard that when it doesn't work out, it could be worse than divorce. So important for any founder to get a sense of who the person is across the table from him, and get a sense for what they've invested into and what value that they've brought to that particular company. Often I'd advise any founder to do a reference check, speaking to founders that particular angel's invested into, to get a sense of what value he or she's brought to their business. As mentioned earlier, our average investment is 700,000 Rand for roughly 20% of equity in the business, and our preference is for straight equity deals, so cash for equity. Where we can't come to a valuation, we do convertible notes, and essentially what a convertible note is a debt instrument that converts to equity at some point in the future. They're trigger mechanisms that we agreed to upfront. Those trigger mechanisms could be the next round of funding, an exit, or time. We have done SAFE agreements in the past. SAFE is an acronym for Simple Agreement for Future Equity. It's a new derivative instrument which has become popular initially in the US and now making its way across the world. SAFE agreements in the South African context, though, have not been legislated. So there's no legislation governing SAFEs, and for a few reasons we are steering clear of SAFEs, and our preference is for convertible notes, which we're essentially able to execute just as quickly as a SAFE, but gives us more comfort in terms of balance sheet management. There are probably almost 10 different methodologies to valuing your business in the early stages. So the most popular of these being the discounted cash flow, the venture capital method, and comparables method. Often though, these methods are not possible for whatever reason. Data is not available, information is not where it needs to be, and as a result, investors then defer to using things like convertible notes. But important that any founder familiarizes themselves with the various methodologies, calculates that valuation where possible, and if there are 10 methods, then calculate your valuation on as many as possible. Let's say it's only possible to get 6 of the 10. Often you'd find that there are outliers, something that's either too far out on the top or too far out on the bottom. Knock out those outliers, use an average of the remaining methodologies, and try and triangulate a value that makes sense and that you can justify to any investor. I think the post-investment support you get from your angel, or any investor for that matter, is really a function of what the business needs at the time and the level of comfort that the investor needs. It can range, so there's a whole spectrum of support. We've done as often as daily phone calls, weekly meetings, bi-weekly or fortnightly meetings, and that spectrum could range. You could do workshops on a monthly basis, or you could do, I mean, the very far end of the spectrum is quarterly updates. Just getting a quarterly update from the founding team on where the business is and what the current challenges are. It really is a function of what the business needs, what level of comfort the investor has in the business, and whether they want to assist in any way and have capacity to assist in any way. I think it's important for the angels to note that the business remains the founders, not to assume the role of the CEO, not to do the work of the management team, and to understand that there are corporate governance responsibilities. So if they are shareholders, their responsibilities is of that of a shareholder. If they then take a seat on the board, they're then shareholders and board members, then their additional responsibilities. But what they're not is the CEO of a business. They are not the operational day-to-day management of that business. Those touch points are important, but it's still the founder's business. I think it's important to note that when an angel looks at an investment opportunity, they see both the return potential as well as the potential risks associated with an investment. And there are a whole range of risks that we could discuss. I think the 4 most important ones are product risk. Does the product do what it says it's going to do? Is it really solving a market need? The second one is market adoption risk. Are customers willing to pay money for the solution? Will they adopt the solution? The third one is team and execution risk. Is this the right team to execute on the solution? And what are the risks associated with this team? And then the fourth one, the fourth most important of these risks, is technology risk. And that's a question of whether the architecture is robust enough to withstand hacks, is strong enough for security purposes, and are they using solutions that are up to date? We often see the adoption of technology and new implementation of technology accelerated at such a fast pace that the last thing you want to do is back a particular technology and that becomes obsolete within a year or so of your investment. So important for you to understand that technology risk as well. I think the first thing that any entrepreneur should realize is that the investment process is a lengthy one. On average, it takes us between 6 to 8 weeks. The quickest we've done in investment is 2 weeks, but that was a complete exception to the rule. And during lockdown, the current restrictions that we're under, that 6 to 8 weeks is almost doubled because we can't visit, we can't do site visits. Transport flights are all limited, so we are in the process of concluding an investment now that took us 12 weeks. Yeah, just important to realize that there are going to be a number of engagements over that time, and that the investment documents that are expected of you will be requested over time. The most important of these is the pitch deck. And that's usually the first thing that any investor is going to ask for. That pitch deck, if it's not detailed enough, the investor could then ask for a business plan, and that business plan would then include financials, historical and forecasted. As you go through the investment process, you may be asked for company registration documents, shareholders agreements, CVs of the directors, key staff members, tax clearance certificates, etc., etc. So those are the most important ones. I think of all of them, the pitch deck is probably the most important. The objective of any pitch is really to make a personal connection with the person across the table from you. I mentioned this earlier, that angel investing and VC investing to a large extent is very much a human endeavor. It's about that personal connection. So I think that should be your primary objective. Make a connection, develop a relationship. And I think a lot of entrepreneurs go into that sales pitch trying to sell. Important that you try and make a connection first. I think also come prepared. And make sure you've done your homework, make sure that it flows, you've practiced appropriately. You should be excited about what you're doing. When you're talking about your passion, it should automatically flow. As soon as that doesn't, and there's a break in that connection as well, you lose your audience. So important that you do those things. There's probably a whole lot more, but I think most importantly is just make a personal connection. Angels bring three things to the table: knowledge, networks, and capital. Now, often, and understandably so, the starting point of the conversation is generally around capital. As a founder, you know you need money, you know you need X amount to get you through this next phase, and so that's what you ask for. But then it's important in your engagements to understand what knowledge and networks that this angel brings to the table. And these knowledge and networks, so it's knowledge on your space and networks within your space that the entrepreneur can draw on after the investment. I think one of the most prominent investors in the US, a guy by the name of Ron Conway, the first thing he does after he's invested into a business is share his contact list with the founder. And it's a case of, here are my contacts. Who within this network do you think can add value to your business? And I'll make a warm introduction on your behalf. I think the first thing is to practice. Practice with friends, family. Do your pitch a few times. Get comfortable with the content. Don't memorize the content. Rather speak through the content. Often you forget a word here or there, and then you're having to check yourself. Rather talk through the content. This is something that you're doing for a living, that you're passionate about. So that passion needs to flow as you're speaking. So the first thing is practice. Second thing is be prepared. So there's often a list of questions that you may get. Understand what those questions could be. The third thing is be punctual. Just make sure that you are there on time, and prepared and professional. And then just to also do your homework on the investor. Understand what he or she invests into. It's pointless going and approaching a venture capitalist, for example, that has a mandate in the financial sector and you're an edtech business. Similarly, angels have a preference for certain sectors. Try and get a sense of where your angel would like to invest into, and also who their portfolio companies are. Go and do your homework and understand the synergies between your business and their portfolio companies.